Good morning. The business of insurance is not like any other business. And by that, I mean that if you were to buy a car from someone or a corporation, you'd write a check and they'd give you the car. But with insurance, this week, this trial, you're going to learn from the witnesses who come up and testify that in insurance, you pay a premium, and what you get in return is a promise. A promise that if a bad thing happens, if your house burns down, if your car is wrecked, if your roof is destroyed by hail, that the insurance company promises that they will pay within the terms of the promise. Now, what the corporation is selling is a promise. But the actual institution of insurance, this company, this business we call insurance, well, it's really actually four functions. Four functions. And by that I mean the first function of insurance is called product design or actuarial. And those are the folks that decide what sort of promise are we going to sell. Do we want to sell a product for folks that are kind of high risk, and so they will pay a high premium? Do we want to sell a product for a promise for folks that are real safe and take a lower premium? Their job in this whole big scheme of insurance, their job is to make sure that the price is set, to make sure that they make a fair profit. And folks, there's nothing wrong with that. That's the job, to set it in such a way that they make a profit. That's the function. The next function of insurance is the marketing function. So once we've designed this insurance product, once we're offering this promise, once we have this product, how are we going to get folks interested in buying it? Do we use advertising? Sales folks? How are we going to get people interested in wanting this product? The third function of insurance is called underwriting. Underwriting. You will learn that underwriting, those are the folks, once we've drawn some excitement, once we've got people interested in buying the product, underwriting, those are the folks who decide whether the people who want this product actually meet the criteria to be sold this product. All three of these functions that we've talked about, you will learn the function and the focus of all three of these functions, these three, is to be thinking about profit. Profit. And folks, there's nothing wrong with that. Insurance companies are in the business of making money. And the three functions we've just outlined, you will hear, that's what their focus must be. But now it comes to the fourth function, the claims department. The claims department. The claims department is the part of the insurance company that delivers on the promise when something happens. And folks, clearly not every promise that the insurance company sells results in a claim. There are people who have spent 40 years driving and have never filed a claim. But the claims department becomes involved once the claim has been made. So a claim has been made. What you're going to learn this week is that when it comes to paying claims, it's not proper for the insurance to be concerned with profit. Does it mean pay fake claims? Not at all. Does it mean pay fraudulent claims? No. Does it mean if somebody wants a $25,000 roof repair and it can be brought in for $23,000, nothing wrong with that. But what they are not supposed to focus on in claims is to support the profitability line of the insurance company. They are not, another way of saying is they're not the profit center of the company. But what are they supposed to be concerned with, you ask? What are they supposed to be focusing on? You will hear from every single person who comes up. Doesn't matter who calls them up this week, you will hear the same thing. The answer: fairness. Fairness. So understand the function of insurance. They can create a product and set a price however unfair they want. They can market it in various ways however they want. They can decide who to sell it to or who not to sell it to formulate profit. But when it comes to that, what's called the special obligation recognized in insurance at the claims department, they are not to be concerned with self-interest. They are not to be concerned with money. It's industry-wide. You will hear from everyone this week the same thing. The point of the claims department is to be fair, to deliver on the promise, and to do whatever it takes to deliver on the promise. Okay. So, you already know from this morning that this was a car crash. That what happened here was a car crash and it happened in December of 2007. You already know that. But that's not exactly where the story exactly begins. To actually begin this story, I have to take you back to April of 2007. And that was with the promise. Don Etherton, in April of 2007, was 43 years old. And he owned a very small construction company, basically just him. And he owned a 1997 Ford F-150 work truck that he worked with. And it was time to renew his insurance policy. So Mr. Etherton did some comparative price shopping. And he got a quote from Owner's Insurance Company for $1,399.54 for 1 year of car insurance for $1 million of coverage. And I will tell you that part of that policy, the part of the policy that's important for today and what we're doing this week, was uninsured motorist coverage. And let me say this, actually in this case, underinsured motorist coverage. And what that means is if you're hit by someone who doesn't have much coverage and you're injured badly and you exhaust all the coverage of that person's insurance that hit you, you can look to your insurance to, if you will, bridge the gap up to the top of whatever coverage you had. And in this case, it was $1 million. So that's the promise. That's April. Now I need to take you to December 19, 2007. Still within the terms of that insurance coverage with auto owners. It's December 19. It's the week of Christmas. It's 4 p.m. Don Etherton is driving his work truck home. He's at Ken Pratt Boulevard at Sherman Drive in Longmont. He stops for the light, and at the light he gets hit by a 19-year-old named Tom Worson driving a 1992 Toyota 4Runner. And he was driving about between 30 and 35 miles an hour. Now at the crash scene, and even that day, my client didn't have any pain. He felt no pain at the scene of the accident. So after they exchanged information, and my client took Mr. Worson, drove Mr. Worson home, because his car was not able to drive anymore, he thought he was fine. It's not until the next day that Mr. Etherton felt back pain. And I will fast forward that over the next 2 years, my client had 3 surgical procedures called transforaminal low back epidural injections at surgery centers using something called fluoroscopy. But he also had 2 open back surgeries on his L5-S1 called discectomies. But he also had 1 open L5-S1 fusion where they took cadaver bone, they replaced his disc, and they fused his spine forever. But he also had permanent 20-pound work restriction, no lifting over 20 pounds. But he also had $400,000 worth of medical bills for those procedures. But he also had Dr. Joe Ramos, who had followed him for years, detailing that he would require, guaranteed based on his injury, $400,000 to $450,000 of future medical needs over the course of his life. So now I need to take you to June of 2009, 2 years after the accident, more or less. After the 3rd back surgery, the fusion, which would actually be the 6th procedure under surgical conditions, Tom Worson's insurance company, AAA, agreed to surrender. They'd seen enough. They agreed to surrender the $250,000 that Mr. Worson had on his policy to Mr. Etherton. Now, that doesn't take care of the $400,000 worth of medical bills, but it's a start. This, folks, is where Don Etherton looks to his insurance company to bridge the gap from that $250,000 up to the $1 million worth of coverage that my client paid for with that promise back in April of 2007. So July 6, 2009, we bundle all the medical records and all the medical bills and all the documents and what all the doctors are saying about the future for Mr. Etherton, and we send it to auto owners and we ask them to please pay benefits. Pay the additional $750,000 that would be available to bridge that gap, to bridge what AAA had already paid. These records were sent to Field Representative Joseph French at Owner's Insurance. And you will meet Joseph French. He's coming in tomorrow. He has worked for auto owners 10 years before receiving Mr. Etherton's claim in the mail. And he will tell you tomorrow when he comes in that he feels he fulfilled the company's obligations to Mr. Etherton in the claims department at Auto Owners Insurance. He will tell you that he knew what to do when the claim came in because he was trained by owners on how the claim department is supposed to receive a claim and what they're supposed to do when they get it. He will tell you from his training that the company must first create and implement a reasonable standard for prompt investigation of the claim. Second, he will tell you that the investigation must be what he calls objectively notated, which means it has to be fair and it needs to be written down. Third, he will tell you that if they feel that the case is warranted, the company must promptly retain independent, qualified experts to assist in the fair, reasonable, and prompt investigation of the claim. And fourth, he will tell you that the company's evaluation must be based on facts, but cannot be based on speculation. I need to take you to August 4, 2009. After about a month after the demand packet was bundled and sent to Mr. French, he wrote a letter. And in the letter, he had some questions and he made some comments. The first thing he wanted to mention, and he mentioned, was that there seemed to only be about $700 worth of damage to Mr. Etherton's car. He also wanted to know about the substantial delay it took Mr. Etherton to get care from the time of the scene to when he did. He also pointed out degenerative disc disease that's mentioned in the very first X-ray of Mr. Etherton. And if you see the letter, and I suspect you will, he also wanted to know what was Mr. Etherton's back history like? What was it like before? And you will learn this week that we answered all of the questions and we reminded Mr. French of all of the things he had already been given to look at. For example, we reminded him that while Mr. Etherton's reinforced truck had only $700 worth of damage, poor Mr. Warson's truck had more than $3,200 worth of damage, and that was just an estimate. They walked around and realized that it was a total loss. The engine had been gored by the large trailer hitch on Mr. Etherton's vehicle. The radiator was destroyed. The engine had been pierced. The fenders had been bent. The hood had been buckled. All the fluid came out the bottom of Mr. Warson's vehicle. That's why he needed the ride home by Mr. Etherton. And nobody ever even looked underneath to see how bad the frame was damaged. That's what we reminded him. We also reminded Mr. French from the records he already had that my client didn't have a substantial delay in care. He didn't see a doctor for 2 weeks after this accident that happened on Christmas holiday week And there were 2 national holidays in the time period between the accident and my client getting into care 2 weeks after the car crash. He was also reminded that degenerative, as it's used in the X-ray, my client was 43 years old. And the X-ray said mild to moderate degeneration in the back. And Dr. Guy will be in here later this afternoon and is going to tell you that degenerative changes of mild to moderate on an X-ray of a 43-year-old is normal. In fact, it'd be very unusual to see no degenerative changes, like of a 14-year-old's back. This is normal. We also reminded him that with the MRI that was done, which is you'll hear is the gold standard of imaging, at every level there wasn't a mention of degeneration. It said, at each level of the spine, it said normal, 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 normal. Massive, broad-based herniated disc in the L5-S1. But most importantly, we reminded Mr. French that Don Etherton had no prior back injury, had no prior back symptoms, literally had no prior back anything, ever, before this accident. So now I'll take you 4 months down the road to December 30, 2009. Mr. French advises us that he has now reached a claim decision in this case. And he told us that in his investigation, he never found anything that showed Mr. Etherton was ever symptomatic for a back injury before this crash. He concluded that he found no other event in Mr. Etherton's life that explained this gentleman's 6 surgical procedures and 3 back surgeries other than this car crash. He also told us that he didn't discount in any way anything the healthcare providers said about Mr. Etherton, and that he didn't discount or reprice or apportion away any part of the medical bills to anything other than the crash. And he also said on December 30, 2009, that he will not be paying the requested $750,000. Instead, he would pay $150,000. That was basically the medical bills. If you figure the $250,000 my client already received and this offer of $150,000 more, that's the medical bills. That's not the future medical bills of an additional $400,000 or $450,000. Of course, it's not any pain related to this. It's not the fact that my client, who was a construction worker for 30 years, can't do his job anymore, ever. The medical bills. So after that claim decision, we wrote 3 letters to Mr. French asking him to please reconsider, and asking him to explain exactly how he arrived that this was the value of what the language of the contract said, sustained loss for recovery. Why was this the proper, fair promise for sustained loss of recovery for Mr. Etherton? And the evidence will show that in response to receiving these letters, Mr. French and owners wrote back 3 very short response letters and said always the same thing. That's what we feel it's worth based on our review. So finally, folks, March 23, 2010, we brought a lawsuit against Owners Insurance for their claim decision of December 30, 2009. Folks, that's the case. So I want to come back to you, and I will, when this case is finally done, and I will be asking you at the end to come back, when I come back up here, to enforce the policy promise that my client paid for. And I'm going to ask you also to check another box that says that owner's claim investigation was unreasonable in their denial of benefits to my clients. Thank you. Okay, postscript, two things I want to tell you about that. First of all, the offer that was made before our trial was a statutory offer of $1. I felt I had a lot to overcome there. Secondly, as of this morning, and I haven't been paid yet, it's still on appeal. Ethan's coming in, Ethan McQuinn, my partner, did the Court of Appeals, 10th Circuit Court of Appeals case. At 11 o'clock, I think he's going to come in and talk to you about those issues. But right now, it's worth about $2.6 million. So that's the value of the verdict. The other thing quickly I just want to mention, if I had one story to tell my children about my 24 years of being a lawyer, it'd be the story of Don Etherton. So Don Etherton lost his ability to work. He lost his ability, he never had really an education. So what he does when he realizes he has no ability to use his body anymore, he goes to a junior college, then he transfers, during this case, to CSU. He's graduating from CSU in I believe, a couple of weeks. And then he's headed off, because he's been admitted to law school in Phoenix, Arizona. And I have a feeling, based on that level, who he is, the courage and what he did in this case for us, and his willingness to let us try this case, and his courage to step up and allow him to be judged and be looked at by this scary jury. I think we're going to see Don Etherton again. By the way, one more thing. Don Etherton is here today. And he's right there in the corner. That gentleman who already looks like a lawyer.